There is a final promise that finance makes to the young, a whispered covenant of prosperity that seems to hang in the air of every university lecture hall, every online trading forum, every conversation about the future. It's the promise that with enough cleverness, enough risk, enough of the right information at the right time, you can achieve a kind of escape velocity, launching yourself into a life of wealth and freedom while your peers are still figuring out their careers. This promise fuels the frantic search for the next 100-bagger crypto coin, the meme stock that will go to the moon, the complex option strategy that will turn $1,000 into $1 million. It is exciting, it is seductive, and for nearly everyone who chases it, it is a lie. The truth, the actual blueprint for building lasting, generational wealth, is far less glamorous. It comes not from a 20-something crypto evangelist, but from a 93-year-old man in Omaha, Nebraska, who still lives in the same house he bought in 1958. Warren Buffett's advice for young people is the great antidote to the speculative fever of our age. It is a philosophy so simple, so profoundly straightforward, that it is often dismissed as archaic or out of touch. And yet it remains the single most reliable, most proven pathway to achieving financial independence. The core of this philosophy, the genetic code of his advice, is a two-part strategy that acts as a powerful fortress against the common mistakes that derail the financial lives of millions. First, he argues that the single greatest investment you will ever make is not in a stock, a bond, or a piece of real estate, but in yourself. Your ability to generate income is your primary asset, and expanding it is your primary duty. Second, when it comes to the stock market, your goal is not to be a hero. It is not to find a needle in a haystack. It is to buy the entire haystack, to own a piece of the broad American economy through a simple, low-cost S&P 500 index fund, and then to let the unstoppable force of time and compounding do the heavy lifting. This is a rejection of complexity. It is a declaration of war on the idea that you need to be a financial genius to get rich. Buffett's core thesis is that the greatest financial advantage a young person possesses is not their risk tolerance, but their time horizon. Decades of runway stretch out before you, an asset more valuable than any inheritance or lucky stock pick. This vast expanse of time is best exploited not by taking wild swings, but by building a powerful, ever-growing engine of income and connecting it to a simple, automated investment machine that captures the slow, steady, and inevitable growth of the market. Today, we deconstruct this philosophy. We will not just touch on the surface, we will go deep into the foundational pillars that support this strategy. We will explore the specific stories from Buffett's own life that forged these beliefs. We will dissect the underlying psychological principles that make this approach so effective. We will build practical, step-by-step blueprints you can apply to your own life tonight. We will confront the disastrous path that 99% of people follow, and we will quantify the staggering financial impact of choosing this simpler, more powerful road. This is the roadmap, not to getting rich quick, but to getting rich for sure. This is the final promise, remade and delivered with the weight of a lifetime of evidence. Our journey begins with the most fundamental pillar of all, the true cornerstone of the entire Buffett financial system. It's the idea that before you can even think about optimizing your investment portfolio, you must first optimize the asset that funds it. That asset is you. The single best investment, the one with an infinite return on investment, is in your own skills, your own abilities, your own earning power. This isn't just a quaint piece of career advice. It is the absolute bedrock of wealth creation. Financial capital, the money in your bank account, can be lost. It can be wiped out in a market crash or a bad decision. But human capital, the sum of your knowledge, your skills, and your reputation, can never be taken from you. It cannot be inflated away by the Federal Reserve, and it pays dividends every single day for the rest of your life. For a young person whose financial capital is small, but whose potential human capital is immense, the choice of where to focus is not a choice at all. It is a mandate. You must build yourself into an earning machine. The foundational anecdote that perfectly illustrates this principle took place not in a boardroom or on the floor of the New York Stock Exchange, but in a small classroom in New York City. In the early 1950s, a young Warren Buffett, fresh out of Columbia Business School and armed with the teachings of his mentor, Benjamin Graham, was a walking encyclopedia of financial knowledge. He could dissect a balance sheet with surgical precision. He could value a company based on its assets and earning power better than almost anyone, but he had a crippling, debilitating weakness. He was terrified of public speaking. The mere thought of standing in front of a group of people would cause him to physically get sick. He would literally throw up. He knew that this fear was a cage, a self-imposed limitation on his potential. All the analytical genius in the world would be useless if he couldn't communicate his ideas, persuade others, or negotiate effectively. He recognized that his intellectual horsepower was being throttled by a lack of a single, learnable skill. So in 1952, while working as a stockbroker in Omaha, he saw an advertisement in the paper for a Dale Carnegie public speaking course. He drove to the registration office in a local hotel, put down a $100 bill for the fee, a significant sum for him at the time, equivalent to nearly $1,000 today, and then, in a moment of panic, he drove away and stopped payment on the check. His fear had won. But the knowledge of his weakness gnawed at him. He knew he had to conquer it. A short while later, he saw the ad again. This time, he went back, but instead of handing over a check he could cancel, he handed over $100 in cash. He had committed himself. He had made a direct, non-refundable investment in his own human capital. Over the next 12 weeks, he and about 30 other people practiced speaking in front of each other. They learned how to organize their thoughts, how to present ideas clearly, and most importantly, how to build confidence by taking small, incremental steps. For Buffett, the transformation was profound. He has said repeatedly that the diploma from the Dale Carnegie course is the only one he displays in his office, not his degrees from the University of Nebraska or Columbia. Why? Because it had the most immediate and dramatic impact on his subsequent success. The course didn't just teach him how to speak, it unlocked his ability to teach. Soon after, he began teaching an investing class at the University of Omaha, a move that forced him to refine his own thinking, and eventually attracted his earliest investment partners who would form the seed capital for his legendary career. Even more personally, that newfound confidence gave him the courage to propose to his future wife, Susie Thompson. He saw the $100 investment not as an expense, but as the single highest return capital allocation he had ever made. It paid dividends in his career, in his investment partnerships, and in his personal life, a return that is truly incalculable. The underlying psychological principle at work here is the critical distinction between building financial capital and building human capital, especially early in life. Our brains are wired to think in terms of tangible assets. We see a dollar in a bank account, and we understand its value. Human capital, on the other hand, is intangible. It's the skill set that allows you to generate future dollars. For a young person, the psychological trap is to obsess over the small pile of financial capital they have, trying to grow it from $100 to $1,000 or $1,000 to $10,000 through clever investing. But the math is overwhelmingly against them. A spectacular 50% return on a $2,000 portfolio is only $1,000. It's not life-changing. However, acquiring a skill that increases your annual salary by $10,000 provides that same amount of new capital every single year, year after year, with far less risk. The psychological principle Buffett understood, either intuitively or explicitly, is the concept of asymmetric upside. Investing in a skill has a clearly defined, limited downside, the cost in time and money to acquire it. In Buffett's case, it was $100 and a few hours a week. The potential upside, however, is practically unlimited. That single public speaking skill compounded over his entire career, enabling him to raise capital, negotiate billion-dollar deals, and articulate his philosophy to millions, creating hundreds of billions in value. Most people fail to see this because they are fixated on the immediate, tangible results of financial investments. They are playing the wrong game. The real game for a young investor isn't picking the right stock. It's becoming the kind of person who generates so much income that their investment choices become secondary to the sheer volume of capital they can deploy. This process also creates what psychologists call a competence-confidence loop. As you acquire a valuable skill, your competence increases. This competence leads to better results: a promotion, a successful project, a new client. These positive results then fuel your confidence, which in turn motivates you to tackle even greater challenges and acquire more skills. It is a self-reinforcing cycle of personal and financial growth, an upward spiral that begins with a single, conscious decision to invest in yourself. So how do you translate this into a practical, applied mental model? Here is the blueprint, a 5-step process for systematically increasing your own earning power. First, conduct a brutal skill audit. You cannot improve what you do not measure. Sit down with a piece of paper and create 2 columns. In the first column, list your current skills, the things you are genuinely good at, from writing code, to sales, to graphic design. In the second column, list the skills that your industry, or an industry you want to enter, is willing to pay a premium for. Be ruthless in your honesty. Your goal is to identify the gap between what you have and what the market demands. Look at job postings for positions 2 levels above yours. What skills are listed again and again? That is your target list. Second, engage in targeted market research. Pick one skill from that target list, the one that excites you the most and has the highest demand. Your mission is to find the most efficient path to acquiring it. This is not about getting another 4-year degree. This is about finding the modern equivalent of Buffett's Dale Carnegie course, a coding bootcamp, a digital marketing certification, a sales training program, a professional coaching engagement. Look for programs with proven results, testimonials, and a clear return on investment. The goal is maximum impact for minimum time and cost. Third, apply the 100-hour rule. Commit to spending 100 focused hours on acquiring the foundational knowledge of this new skill. That's roughly 1 hour a day for 3 months. This focused effort is enough to move you from a complete novice to someone with functional, employable competence. The key is deep, focused work, not passive consumption. Don't just watch videos. Build the project, write the copy, make the sales calls. Fourth, use the skill stacking method, a concept popularized by Scott Adams, the creator of Dilbert. The idea is that you don't need to be in the top 1% in the world at one thing to be extraordinarily successful. It is far easier and more effective to be in the top 25% at 2 or 3 different things. A software developer who is also an excellent communicator and writer is infinitely more valuable than a developer who is only a brilliant coder. Look at your existing skill set from your audit and ask, what new skill, when combined with my current strengths, creates a unique and valuable combination? That is your stack. Finally, devise a monetization strategy. A skill is only financially valuable if you can convert it into cash flow. This could mean using your new skill to get a significant raise or promotion in your current job. It could mean starting a side hustle or freelance business. It could mean transitioning to a new, higher-paying career entirely. The crucial step is to explicitly plan how the investment in the skill will translate back into increased income, which you can then use to fuel your financial investments. The antithesis to this approach, the path of the 99%, is a combination of passive consumption and credentialism. This is the path of the person who believes that success is something that happens to you, not something you build. They fall into 2 major traps. The first is the credential trap. This is the individual who endlessly collects academic degrees and certifications, believing that the piece of paper itself is the goal. They might have a bachelor's, a master's, and be halfway through a PhD, but they lack the practical, market-ready skills to command a high income. They have learned how to be good students but not how to create tangible value in the marketplace. They have confused education with skill acquisition, and they often end up with mountains of student debt and an income that doesn't justify the investment. The second trap is the passive learner syndrome. This is the person who consumes endless content, YouTube videos, podcasts, blog posts about personal development and career advice, but never takes action. They feel productive because they are learning, but they are stuck in a cycle of intellectual entertainment. They can tell you the 5 best ways to negotiate a raise, but they've never actually walked into their boss's office and done it. They mistake the accumulation of information for the development of a skill. True skill development requires active practice, feedback, and real-world application. For both these groups, the underlying mindset is the same. It's a lottery ticket mentality. They are waiting for an external event, the right job offer, the perfect business idea, a lucky break, to transform their financial lives, rather than taking methodical, deliberate action to transform themselves into the kind of person who inevitably commands a high income. This passivity is the slow, silent killer of financial dreams. The direct financial connection of this pillar is the most powerful in all of personal finance. Let's quantify the return on investment of investing in yourself. Imagine a 25-year-old named Alex who earns $60,000 a year. Alex spends $2,000 and 100 hours on a data analytics certification course. As a result of this new high-demand skill, Alex is able to secure a new job or a promotion that comes with a $15,000 raise, bringing the annual salary to $75,000. The immediate return on that $2,000 investment is 750% in a single year, but the true impact is revealed over time. Let's assume Alex takes just half of that raise, $7,500 a year, or $625 a month, and invests it into a simple S&P 500 index fund, which we will discuss later. Over a 40-year career, assuming an average annual return of 10%, that extra investment, funded directly by the new skill, would grow to over $4 million. $4 million from a single $2,000 investment in human capital. Now compare that to a scenario where Alex didn't invest in the skill, but instead tried to invest that same $2,000 in the stock market. Even with a miraculous 50% return in the first year, Alex would have only an extra $1,000. The difference is not just in scale, it's in kind. The investment in skills creates a recurring stream of new capital to invest, while a financial investment only grows the capital that already exists. For a young person whose existing capital is small, the choice is mathematically obvious. Your salary, your earning power, is the shovel you use to dig for gold. Investing in yourself is the equivalent of trading in your small garden spade for a massive industrial excavator. The size of the pile of gold you accumulate depends almost entirely on the size of your shovel. This brings us to the second pillar, the silent partner to your earning power. It is the one asset that young investors have in overwhelming abundance, an asset that the wealthiest, most experienced investors in the world would pay billions to have more of. That asset is time. Warren Buffett's entire philosophy is built upon the recognition that a long time horizon is the most powerful force in finance. It is the magic ingredient that transforms modest savings into fortunes. But simply having time is not enough. You must understand the psychology of wielding it as a weapon, of playing the long game in a world that is screaming for you to think in terms of minutes and seconds. The mastery of time, and the patience it requires, is what separates amateur investors from professional wealth builders. It is the understanding that the greatest moves you make are often the ones where you do nothing at all. The foundational anecdote that cemented this principle in Buffett's mind occurred when he was just 11 years old. In the spring of 1942, having saved up $120 from his paper route and other ventures, an enormous sum for a boy his age, he decided to make his first stock market investment. He convinced his sister Doris to go in with him, and they purchased 3 shares of a company called City Service Preferred for $38.25 per share. Almost immediately after they bought it, the stock began to fall. It dropped all the way down to $27 a share. Young Warren was tormented. He felt responsible not only for his own money, but for his sister's. Every day, the price was a painful reminder of his apparent mistake. This experience of immediate loss, the gut-wrenching feeling of watching your hard-earned money disappear, is a crucible that every investor must face. Finally, the stock recovered. When it climbed back up to $40 a share, Warren, eager to lock in a small profit and erase the painful memory of the loss, sold all 3 shares. He made a profit of $5.25 after commissions. He felt a sense of relief, but that relief was short-lived. In the weeks and months that followed, he continued to watch the stock he had just sold. City Service Preferred didn't just stay at $40, it began to climb and climb. It eventually soared to over $200 per share. If he had just held on, their small stake of roughly $114 would have grown to over $600. The lesson was seared into his brain with the intensity that only a childhood mistake can provide. He had been right about the investment, but he had been wrong about the timeline. His impatience, driven by the emotional pain of a short-term drop and the desire for a quick, small victory, had cost him a massive gain. From this single experience, he drew 3 lifelong lessons. First, don't watch the market too closely. The daily fluctuations are noise, designed to provoke emotional, irrational decisions. Second, don't fixate on the purchase price. The sting of seeing the stock drop below what he paid for it was what drove his poor decision. And third, and most importantly, when you buy a piece of a good business, the correct holding period is forever. He learned at age 11 that true investing is not about timing the zigs and zags of the market. It is about harnessing the long, slow, upward march of business value over decades. The underlying psychological principle that makes this lesson so difficult for most people to implement is called hyperbolic discounting. This is a cognitive bias deeply embedded in our evolutionary wiring. Our brains are designed to prefer smaller, immediate rewards over larger, delayed ones. It's the reason we choose to eat a slice of cake now, rather than reap the long-term benefits of a healthy diet. It's the reason we hit the snooze button for 10 extra minutes of mediocre sleep instead of getting up and starting a productive day. In the financial world, hyperbolic discounting is the arch-nemesis of long-term investing. A guaranteed $5 profit today feels much more real and satisfying to our primitive brain than the abstract possibility of a $500 profit years from now. The stock market, with its constantly updating prices and news tickers, is a perfect environment to exploit this bias. It presents us with an endless stream of opportunities for small, immediate emotional payoffs. The thrill of a quick gain, the relief of selling a losing position to stop the bleeding. Warren Buffett's genius lies in his ability to consciously override this primal instinct. He has trained his brain to operate on a different timescale. When he buys a stock like Coca-Cola or American Express, he isn't thinking about what the price will be next week or next quarter. He is thinking about how many people will be drinking Coke or using credit cards in 10, 20, or 50 years. This long-term perspective allows him to completely ignore the short-term noise and emotional volatility that derails other investors. He is essentially playing a different game, one that is perfectly suited to the realities of wealth compounding, but completely alien to the natural impulses of the human mind. The famous marshmallow test, conducted at Stanford University, is a perfect illustration of this principle in another context. Young children were offered 1 marshmallow immediately, or 2 marshmallows, if they could wait for 15 minutes. The children who were able to delay gratification went on to have better life outcomes, higher test scores, and greater success. Long-term investing is the adult version of the marshmallow test, and the market dangles that first marshmallow in front of your face every single day. To combat this powerful psychological bias, you need an applied mental model. Let's call it the time arbitrage model. Arbitrage, in finance, is the practice of taking advantage of a price difference between 2 or more markets. As a young investor, you can perform an arbitrage on time itself, taking advantage of the fact that you have more of it than anyone else and that the rest of the market is irrationally focused on the short term. Here is the 4-step blueprint. First, explicitly define your horizon. Do not think of yourself as a stock market investor. Think of yourself as a business owner who is slowly accumulating shares in the world's greatest companies. Your time horizon is not the next year. It is the next 40 or 50 years. Write down the year you plan to retire. That is your finish line. This single act of framing shifts your perspective from short-term speculation to long-term ownership. Second, calculate the cost of waiting. The biggest enemy of compounding is not a market crash, it's procrastination. Use an online compound interest calculator to see the staggering difference between starting to invest at age 25 versus age 35. A single decade of delay can cost you over half of your potential nest egg. This calculation makes the abstract concept of time tangible and urgent. It transforms the idea of investing later from a benign delay into an act of massive financial self-sabotage. Third, create a decision journal. Every time you feel a strong urge to sell during a market panic or buy into a speculative frenzy, open a journal and write down the date, the situation, the emotion you are feeling, and what you are tempted to do. Then, write down what your 40-year plan says you should do, which is almost always nothing. This act of writing forces you to slow down and engage your rational brain, creating a circuit breaker for impulsive decisions. Over time, reading back through your journal will reveal how fleeting and foolish most short-term emotional urges are. Fourth, and most critically, automate your decisions. The most effective way to defeat hyperbolic discounting is to take your biased brain out of the equation altogether. Set up automatic recurring investments from your paycheck into your chosen investment vehicle every single month. This strategy, known as dollar cost averaging, ensures that you are consistently buying, regardless of whether the market is up or down. It turns market volatility from your enemy into your friend, as you automatically buy more shares when prices are low. Automation is the ultimate commitment device, forcing you to act in your own long-term best interest, even when your short-term brain is screaming at you to do the opposite. The antithesis of this long-game approach is embodied by two characters who dominate the modern investment landscape: the market timer and the action junkie. The market timer is the person who believes they can outsmart the collective wisdom of millions of investors. They are always waiting for the perfect time to invest, sitting on cash while the market climbs, waiting for the inevitable crash. Then, when the crash comes, they are too scared to buy, waiting for the bottom. They often miss the bottom and only buy back in after the market has already recovered significantly. They believe they are being prudent, but in reality, their attempts to avoid volatility cause them to miss out on the powerful, long-term upward trend of the market. The financial services firm Charles Schwab conducted a famous study showing that even an investor with the worst possible market timing, who invested a lump sum at the absolute peak of the market every single year for 20 years, still ended up with a substantial profit. The lesson is clear. Time in the market is vastly more important than timing the market. The action junkie is an even more common figure in the age of zero-commission trading apps. They treat their investment portfolio like a video game or a slot machine. They are addicted to the dopamine hit of making a trade, of being in the action. They check their portfolio dozens of times a day, riding the emotional roller coaster of every minor fluctuation. Their strategy is driven by headlines, tweets, and forum posts. This action bias, the tendency to feel like you should be doing something, anything, is a powerful wealth destroyer. Research from Dalbar, a financial market research firm, has consistently shown that the average investor dramatically underperforms the market index itself. Why? Because they buy high during periods of euphoria and sell low during periods of panic. They are constantly reacting, always busy, and in their busyness they churn their own accounts, rack up taxes, and systematically destroy their own returns. The path of the 99% is paved with frantic activity that ultimately leads nowhere. The direct financial connection of mastering the long game is perhaps the most astonishing concept in all of finance: the magic of compound interest. Let's illustrate this with a tale of two investors, both of whom follow our first pillar and manage to increase their income enough to invest. First, we have Prudent Penny, who starts investing at age 25. She diligently puts away $500 every month, into an investment that earns an average of 10% per year. She does this for 40 years, until she is 65. Next, we have procrastinating Pete. He decides to wait, focusing on other things in his 20s. He finally starts investing at age 35, a decade after Penny. To try and catch up, he invests double what Penny does, $1,000 every month, for the next 30 years, until he is also 65. So who ends up with more money? Pete, the late starter, invests a total of $360,000 of his own money over his lifetime. Penny, the early starter, invests only $240,000. Yet, when they both reach age 65, Pete's portfolio is worth approximately $2 million. Penny's portfolio, however, is worth over $3,150,000. She invested $120,000 less of her own money, but ended up with over $1 million more. That extra $1 million was generated purely by her 10-year head start. It is the ghost in the machine. The earnings on her earnings, the result of time doing the heavy lifting. This isn't a trick. It is the fundamental law of financial physics. Your greatest asset as a young investor is the sheer number of compounding cycles you have ahead of you. Every year you delay starting is not just a year of lost contributions. It is a year where you forfeit the growth on all the contributions that came before. Leveraging time is not just a good idea, it is the entire game. Having established the foundational importance of investing in yourself to maximize your income and the critical need to adopt a long-term mindset, we arrive at the third pillar. This is the practical, mechanical heart of the Buffett strategy for young people. If your income is the fuel and time is the runway, this pillar is the engine itself, the specific vehicle designed to carry you to your destination with maximum efficiency and minimum effort. It is Buffett's answer to the question, where exactly should I put my money? And his answer, repeated for decades, is a thunderous endorsement of simplicity. He advocates for a low-cost S&P 500 index fund. This isn't a secret formula or a complex financial product. It is a decision to stop searching for the winning needle and instead to simply buy the entire haystack. It is a philosophy of owning a slice of the broad American economy and harnessing its collective growth rather than trying to outsmart it. For the vast majority of investors, especially those just starting out, this is not just the best option. It is the only option that makes rational sense. The most powerful foundational anecdote for this pillar is not a story from Buffett's early life, but a very public and very high-stakes wager he made in his later years. In 2007, Buffett issued a challenge to the entire investment industry. He wagered $1 million of his own money that over a 10-year period, a simple, unmanaged, low-cost S&P 500 index fund would outperform a hand-picked portfolio of hedge funds. Hedge funds are the pinnacle of active investment management. They are run by supposedly the smartest minds in finance, equipped with advanced algorithms and armies of analysts, and they charge exorbitant fees for their alleged expertise. A firm called Protégé Partners, led by a man named Ted Sedes, accepted the bet. Sedes was confident. He and his team selected 5 funds of funds, portfolios that themselves invested in a variety of different hedge funds. This was the best of the best, a curated selection of Wall Street's finest, pitted against Buffett's dumb index fund. The bet began on January 1, 2008, just before the global financial crisis, which should have been a perfect environment for skilled hedge fund managers to protect capital and outperform. The terms were simple. Whichever side had the higher average annual return after 10 years would win, with the $1 million prize going to the winner's charity of choice. For the first year, during the crash of 2008, the hedge funds did indeed do better. The S&P 500 was down 37%, while the hedge funds were down only about 24%. But that was the only year they were ahead. As the market began its slow, grinding recovery, the power of the index fund began to assert itself. Year after year, the S&P 500, representing the raw, unadulterated performance of American business, chugged along. The hedge funds, meanwhile, were being eaten alive by their own complexity and, more importantly, their fees. Their layers of management fees, performance fees, and administrative costs acted as a constant, heavy anchor, dragging down their returns. The results were not even close. By the end of the 10-year period in 2017, the S&P 500 index fund that Buffett had selected, the Vanguard 500 Index Fund Admiral shares, had achieved an average annual return of 8.5%. The basket of elite hedge funds chosen by Ted Seides had returned an average of only 3.0%. The index fund didn't just win, it crushed the so-called smart money. Buffett's million-dollar prize for his charity, Girls Inc. of Omaha, had grown to over $2.2 million. The hedge fund's stake would have yielded only about $360,000. Buffett used this very public victory not to gloat, but to teach a powerful lesson. He proved in a real-world high-stakes experiment that for most people the quest to beat the market is a fool's errand, one that enriches Wall Street at the expense of Main Street investors. The simple, cheap, and boring option was, in fact, the most powerful. The underlying psychological principle that explains why this simple strategy is so effective and why so many people reject it is the Dunning-Kruger effect combined with overconfidence bias. The Dunning-Kruger effect is a cognitive bias in which people with low ability at a task overestimate their ability. In investing, this manifests as amateurs believing they can easily outperform seasoned professionals. They read a few articles, watch a few videos, and suddenly feel they have an edge. Overconfidence bias is the tendency for a person to be more confident in their own abilities than is objectively reasonable. When it comes to picking stocks, almost everyone believes they are an above-average picker. This is, of course, a statistical impossibility. The financial media and the entire active investment industry are built on fueling this delusion. They sell the idea of genius stock pickers, of secret knowledge, of being able to find the next Amazon before anyone else. This narrative is deeply appealing to our ego. The idea of just buying the average, of admitting that you don't know more than the collective market, feels like giving up. It feels unsophisticated. The reality, as Buffett's bet demonstrated, is that the stock market is a brutally efficient and competitive environment. The price of a stock at any given moment reflects the collective knowledge and analysis of millions of smart, motivated people all over the world. To consistently beat that collective wisdom is extraordinarily difficult. Furthermore, Buffett understands that active investing is largely a negative-sum game. In a positive-sum game, like a growing economy, the total value can increase for everyone. But when you try to beat the market, you are playing a zero-sum game against other traders where one person's gain is another's loss. When you factor in the costs, trading commissions, management fees, taxes, it becomes a negative-sum game. The only guaranteed winner is the house, the financial intermediaries charging the fees. By choosing a low-cost index fund, you are opting out of this rigged game. You are choosing to accept the market's average return, which, over the long run, has been incredibly powerful, and you are doing so at the lowest possible cost. It is an act of profound humility and intellectual honesty, a rejection of ego in favor of arithmetic. So how do we turn this insight into a workable blueprint? We build the set-and-forget fortress, a 5-step plan for implementing this strategy flawlessly. First, choose the right vehicle. You are looking for a low-cost, broad-market index fund, or ETF. The S&P 500 is Buffett's classic recommendation because it represents about 80% of the U.S. stock market's value. Popular choices include Vanguard's VOO, iShares, IVV, or Schwab's SWPPX. The specific fund is less important than its core characteristic. It should track a major index and have a rock-bottom expense ratio. Second, master the expense ratio. This is the single most important number to look for. The expense ratio is the annual fee the fund company charges to manage the fund. For a good S&P 500 index fund, this number should be incredibly low, something like 0.04%. This means for every $10,000 you have invested, you are paying only $4 a year in fees. Compare this to actively managed mutual funds, where fees of 1% or more are common. A 1% fee on $10,000 is $100 a year. This might not sound like much, but as we'll see, over a lifetime, this difference is devastating. Third, automate your investment. As discussed in the previous pillar, this is non-negotiable. Go into your brokerage account and set up a recurring transfer and automatic investment from your bank account for the day after you get paid. This ensures you pay yourself first and transforms your investing from an active decision into a passive habit, like breathing. Determine an amount you can afford and start. You can always increase it later. Fourth, ignore the rebalancing illusion. You will hear financial advisors talk about rebalancing your portfolio. For a complex portfolio with many different asset classes, this can make sense. But for a young investor whose entire strategy is to own one single diversified fund like the S&P 500, there is nothing to rebalance. The fund itself is constantly self-rebalancing as companies grow or shrink within the index. Your job is not to tinker, your job is to add more fuel. Fifth, adopt the psychological black box approach. The biggest risk to this strategy is you. It's your temptation to sell in a panic or to stop investing when the news is bad. The best way to prevent this is to treat your investment account like a black box. Once it's set up and automated, you have no reason to look at it more than once a year. Do not check the balance daily or weekly. Remove the brokerage app from your phone's home screen. The less you look, the less you will be tempted to meddle, and the better your long-term results will be. Your fortress is designed to protect your money not just from the market, but from yourself. The antithesis to this elegant simplicity is the path followed by the vast majority of aspiring investors, the stock picker's delusion. This is the person who believes that financial independence is just one great stock pick away. They spend countless hours reading analyst reports, watching financial news, and scouring online forums for the next big thing. They see themselves as a shrewd, undiscovered Peter Lynch, or indeed, a young Warren Buffett. But they fail to realize that Buffett's success came not just from picking stocks, but from buying entire companies, influencing management, and having a structure, Berkshire Hathaway, that provided immense structural advantages. The average person has none of these tools. Their journey is one of emotional whiplash. They feel like a genius when a stock they picked goes up, their overconfidence soaring. They feel like a failure when it plummets, their fear causing them to sell at the worst possible time. They are engaged in an activity that provides the illusion of control and sophistication, but the statistical reality is brutal. Study after study confirms that the vast majority of individual investors fail to beat the market average over time. More damningly, data from groups like S&P Dow Jones Indices consistently shows that over any given 10 or 15-year period, more than 85% of actively managed large-cap mutual funds run by full-time professionals also fail to beat their benchmark, the S&P 500. If the highly paid professionals with teams of PhDs can't do it, the odds that an amateur working in their spare time can are infinitesimally small. The stock picker's delusion is a costly and stressful hobby masquerading as an investment strategy. The direct financial connection here is the inescapable brutal math of fees. Let's quantify what Buffett calls the tyranny of fees. We'll compare two investors. Investor A follows our blueprint and puts her money in an S&P 500 index fund with an expense ratio of 0.04%. Investor B, seeking to beat the market, puts his money in an actively managed mutual fund with a seemingly reasonable expense ratio of 1.04%. That is a difference of just 1%. Both investors start with nothing at age 25 and invest $1,000 a month for 40 years. We'll assume both the market and the active fund manager achieve the same gross return of 10% per year before fees. After 40 years, Investor A, the index fund investor, will have a portfolio worth approximately $5,310,000. Investor B, the active fund investor, will have a portfolio worth approximately $3,860,000. The 1% fee has cost him nearly $1.5 million. It has consumed almost 30% of his potential nest egg. That is the devastating, corrosive power of fees over a long time horizon. The fee didn't just remove 1% of his capital each year, it removed 1% of his principal and all of its future potential earnings, creating a compounding effect that worked against him. For a young investor, choosing a low-cost index fund is the single biggest and easiest financial decision they can make to maximize their retirement planning outcome. It is a guaranteed win, a structural advantage you give yourself from day one simply by choosing the path of simplicity and low cost. We have now established a powerful three-part foundation: build your income, leverage your time, and automate your investments into a simple, low-cost vehicle. But there is a fourth pillar, and it is a defensive one. It is the fortress wall that protects everything you are building. This pillar is about conquering the single greatest enemy to your long-term success, the enemy within. It is the mastery over the speculative temptations that will inevitably arise to try and pull you off course. The world will constantly present you with seemingly easy, fast ways to get rich. A new technology, a hot stock, a cryptocurrency soaring in value. These opportunities create a powerful psychological pull, a fear of being left behind. Buffett's fourth crucial piece of advice is to develop the discipline to resist this pull, to understand the profound difference between investing and speculating, and to stay firmly within your circle of competence. This is not about being timid. It is about being a professional. It's about recognizing that the preservation of your capital is far more important than the pursuit of spectacular, high-risk gains. The foundational anecdote that taught Buffett this lesson in the most painful way possible was his purchase of Dexter Shoe Company in 1993. On the surface, it looked like a classic Buffett deal. Dexter was a well-known American shoe manufacturer with a strong brand, a long history of profitability, and a durable competitive position, or so he thought. Buffett was so confident in the deal that he didn't pay for it with cash. He paid for it with Berkshire Hathaway stock, exchanging 25,203 shares of Berkshire A, worth $433 million at the time. He would later call this his worst deal ever, a total disaster. What went wrong? Buffett had identified a good business, but he failed to recognize that its competitive moat was about to be completely and permanently erased. Low-cost foreign competitors began to flood the market with shoes that were just as good, but far cheaper to produce. Dexter's brand and American manufacturing base, once its greatest strengths, became its Achilles heel. The business's profitability quickly evaporated, and within a few years it was worthless. The $433 million investment went to zero, but the true cost was far greater. Because he had used Berkshire stock to buy it, the real cost was the opportunity cost of what those shares would be worth today. Those 25,000 shares of Berkshire A are now worth over $15 billion. It was a multi-billion-dollar mistake. What lesson did Buffett take from this? He realized he had stepped outside his circle of competence. He understood balance sheets and brands, but he didn't fully understand the dynamics of the shoe industry or the unstoppable macro trend of globalized manufacturing. He had made a speculation. He speculated that Dexter's past performance and strong brand could protect it from the changing world. He was wrong. This painful public failure reinforced in him a core discipline. Do not stray into territory you do not understand, no matter how attractive the price seems. The potential for a permanent loss of capital from a single, major mistake far outweighs the potential gains from venturing into unfamiliar territory. The underlying psychological principles that drive us toward these kinds of speculative mistakes are herd mentality and the fear of missing out, or FOMO. As social creatures, our brains are hardwired for social proof. We look to others for cues on how to behave, especially in situations of uncertainty. When we see a large group of people getting excited about an investment, whether it's housing in 2006, tech stocks in 1999, or a new cryptocurrency today, it triggers a powerful, primal urge to join the herd. Resisting this urge feels physically uncomfortable. It feels like you are the one who is crazy, the one who is missing the obvious. This is FOMO. It is a form of social anxiety applied to finance. The pain of watching your friends and neighbors get rich from an asset you don't own can be more powerful than the pain of losing money yourself. Speculative bubbles are built on this psychological foundation. The narrative shifts from the underlying value of the asset to the fact that its price is going up. People buy not because they've analyzed the business, but because they believe they can sell it to someone else, a greater fool, at a higher price later on. The greater fool theory is the ultimate expression of this mentality. You may know that a digital token or a non-producing asset is fundamentally worthless, but you buy it anyway, betting that someone else's FOMO will be even greater than yours. This is not investing. It is a high-stakes game of musical chairs, and it inevitably ends with a lot of people left with no chair when the music stops. Buffett's discipline is a conscious and deliberate rejection of social proof as an investment indicator. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." This is the mantra of someone who has insulated their decision-making process from the madness of the crowd. To build this same insulation, you need a practical mental model. This is the Circle of Competence discipline, a 4-step blueprint for avoiding speculative disaster. First, you must explicitly define your circle. Take out a piece of paper and write down the industries, business models, and technologies that you genuinely understand with a high degree of clarity. For most of us, this is a very short list. It might be related to your profession or a lifelong hobby. The key is brutal honesty. If you cannot explain how a business makes money and why it will continue to make money in 10 years, it is outside your circle. Second, create a too-hard pile. This idea comes directly from Buffett and his partner Charlie Munger. For any investment opportunity that comes your way that is outside your predefined circle, you do not need to analyze it to death. You simply place it in a mental too-hard pile and move on. For a young investor using an index fund strategy, this is even simpler. Everything that is not your S&P 500 index fund belongs in the too-hard pile. This isn't ignorance. It's a highly efficient filtering mechanism that protects your most valuable assets, your time, your attention, and your capital. Third, develop an anti-FOMO checklist. When you feel that powerful pull of a hot trend, force yourself to slow down and answer a series of questions before taking any action. Questions like, am I buying this because I have a deep understanding of its long-term value, or because the price has been going up recently? Am I feeling rushed to buy this right now? If I couldn't sell this for 10 years, would I still be excited to own it? Can I explain my investment thesis for this to a 5-year-old? This checklist acts as a cooling mechanism, re-engaging your rational mind and short-circuiting the emotional hijack of FOMO. Fourth, go on a news diet. The financial media is an engine designed to generate clicks and views by promoting drama, hype, and fear. Constant exposure to this environment is poison for a long-term investor. Drastically reduce your consumption of daily financial news. You do not need to know the stock market's every move. Remember, your strategy is automated and has a 40-year time horizon. By intentionally curating your information intake, you can create a calmer, more rational mental environment, making it far easier to stick to your plan. The antithesis of this disciplined approach is the gambler's fallacy in action. This is the path of the person who treats the market like a casino, constantly chasing the next big win. We have seen this story play out time and time again. In the late 1990s, it was people quitting their jobs to day trade .com stocks with no earnings and no business model. convinced that, quote, "this time is different." They confused a speculative bubble with a new paradigm, and many were financially wiped out when the bubble burst in 2000. In the mid-2000s, it was the belief that housing prices could only go up, leading people to take on reckless levels of debt to flip houses, a speculation that led to the global financial crisis. More recently, we've seen it in the frenzies around meme stocks and cryptocurrencies. The psychology is always the same. A new asset with a compelling story captures the public imagination. Early adopters make fortunes, and their stories are amplified by social media, fueling a massive wave of FOMO among the general public. People pour money in, not based on any fundamental analysis, but on the hope that the price will continue its meteoric rise. They are not investing in a business, they are betting on a number going up. The tragedy is that this path is so alluring because it offers the promise of a shortcut, a way to bypass the slow, methodical process of building real wealth. But these shortcuts almost always lead off a cliff. The path of the speculator is paved with incredible highs and catastrophic soul-crushing lows, and for the vast majority, it ends in a place far worse than where they started. The direct financial connection of avoiding speculation is about understanding the brutal asymmetry of losses. Gaining money and losing money are not emotional or mathematical opposites. The psychological pain of a loss is felt roughly twice as intensely as the pleasure of an equivalent gain, a concept known as loss aversion. But the mathematics are even more unforgiving. If you have a $10,000 portfolio and you suffer a 50% loss, you are left with $5,000. To get back to your starting point of $10,000, you don't need a 50% gain, you need a 100% gain. A single, catastrophic loss requires a subsequent heroic effort just to break even. This is why capital preservation is rule number one. The S&P 500 index fund strategy is designed with this principle in mind. By owning 500 of the largest companies, you are massively diversified. The odds of a single company's failure, like Dexter Shoe wiping out your portfolio, are zero. The index will certainly have periods of decline, but it has always recovered because it is a self-cleansing mechanism. Failing companies are removed and replaced by new, successful ones. Speculation, on the other hand, exposes you to the risk of a 100% permanent loss of capital. When you bet everything on a single, high-risk asset, you are violating the most fundamental rule of financial survival. Avoiding speculation is not about limiting your upside. It is about ensuring you stay in the game long enough for the power of compounding to work its magic. It is the defensive strategy that guarantees your offensive strategy has time to succeed. This brings us to our fifth and final pillar, the one that ties everything together. This is the master plan, the synthesis that transforms the first four pillars from a collection of good ideas into a single, cohesive, and self-reinforcing system for wealth creation. We can call it the compounding flywheel. A flywheel, in mechanics, is a heavy wheel that takes a great deal of effort to get spinning. But once it's in motion, its momentum makes it easier and easier to keep turning, and it stores and releases massive amounts of energy. In your financial life, the goal is to create a similar flywheel, where your growing income, your automated investments, and your disciplined mindset all feed into each other, creating a virtuous cycle that accelerates your wealth creation exponentially over time. This is not just about earning and investing in parallel, it's about creating a feedback loop where each component makes the others stronger. The perfect foundational anecdote for this concept is not a single story from Buffett's life, but the very structure of his masterpiece, Berkshire Hathaway itself. The engine at the core of Berkshire's phenomenal success, especially in its early decades, was its insurance operations. Buffett realized that the business of insurance had a unique and magical characteristic. Insurance companies collect premiums from customers up front and then hold that money, sometimes for years or even decades, before they have to pay it out in claims. This pool of money, which doesn't belong to Berkshire but which it gets to hold and invest for its own benefit, is called float. For most insurance companies, float comes at a cost. They often pay out more in claims and expenses than they collect in premiums, an underwriting loss. But Buffett, a fanatic for disciplined underwriting, insisted that his insurance companies, like Geico and National Indemnity, be run to produce an underwriting profit. This meant that he was effectively being paid to hold and invest other people's money. This was the first part of his flywheel, a massive, ever-growing, and very low-cost source of capital generated by the primary business operations. The second part of the flywheel was what he did with that float. He used it as a gigantic, permanent pool of capital to buy stocks and acquire entire companies, from Coca-Cola to the BNSF Railway. The profits from these investments then flowed back to Berkshire, increasing its overall financial strength, which in turn allowed its insurance companies to write even more policies, generating even more float. It's a breathtakingly elegant system. The insurance operations, the income engine, feed the investment operations, the wealth compounding engine, which in turn strengthens the insurance operations. One side of the business pushes the other, building momentum that, over 50 years, has become an unstoppable force. This is the model we seek to replicate in our own personal financial lives. The underlying psychological principle that makes this flywheel concept so powerful is what Charlie Munger calls Lollapalooza effects. Munger's theory is that when several positive factors start working together in the same direction, the result is not simply additive, it is multiplicative. It's a chain reaction where 1 + 1 + 1 doesn't equal 3, but 30. In the context of your personal finances, think about the interconnected forces we've discussed. Investing in yourself, Pillar 1, not only increases your income, but it also increases your confidence and competence, which makes you a better long-term thinker and investor, Pillar 2. Automating your investments into a low-cost index fund, Pillar 3, removes emotional decision-making, which frees up mental energy that you can then reinvest back into developing your skills. Avoiding speculation, Pillar 4, preserves your capital, ensuring that the flywheel never has to stop and restart from a lower base. All of these elements are interconnected. The psychological shift comes when you stop seeing your financial life as a series of separate tasks, earning, saving, investing, and start seeing it as one integrated system. Your career is not separate from your portfolio. Your daily habits are not separate from your net worth. Everything is connected. When you align all of these forces, you create a powerful psychological momentum. Your progress begins to feel inevitable, which further motivates you to stick with the system, which in turn accelerates your progress. This is the Lollapalooza effect in action, a cascade of positive feedback loops that can transform a modest financial start into an extraordinary outcome. To build this in your own life, you need the personal flywheel blueprint, a 5-step system for integrating these pillars. First, calculate your investable income. This is your after-tax income minus all of your essential, non-negotiable living expenses. This is the fuel for your flywheel. Your primary goal, at all times, is to make this number larger. Second, create the skill-to-income conversion pipeline. This is where you formalize your commitment to Pillar 1. Dedicate a fixed percentage of your income, perhaps 5%, or a fixed dollar amount every month, specifically to upskilling. This is not saving. It is a capital expenditure on your own human capital. This ensures that you are systematically working to increase the size of your shovel. Third, build the income-to-investment pipeline. This is where you weaponize your future success. Make a commitment, in writing, to automatically invest at least 50% of every future raise, bonus, or income increase you receive. This single rule is the ultimate antidote to lifestyle inflation and the key to dramatically accelerating your flywheel. As your income grows, your investment rate grows even faster. Fourth, establish the feedback loop. As your investment portfolio begins to grow and generate dividends, or more importantly, as it provides you with a sense of financial security, you can use that security to take smarter career risks. Perhaps you can now afford to move to a city with more opportunities, or start a side business, or negotiate for a commission-based role with higher upside. Your financial capital starts to fuel your human capital, which is the final, powerful connection that makes the flywheel spin at maximum velocity. Fifth, conduct an annual review. Once a year, sit down and look at your system. Is your income growing? Is your investment rate increasing? Are your skills becoming more valuable? The goal of the review is not to check your portfolio's performance, but to assess the health and speed of your flywheel itself. You are no longer just an investor, you are the chief engineer of your own personal wealth creation machine. The antithesis of the flywheel model is the single most common financial affliction among modern professionals, the lifestyle inflation trap. This is the person who seems to be doing everything right. They work hard, they get promoted, their income steadily rises throughout their career. Yet, somehow, they never seem to build any significant wealth. They are stuck on a hedonic treadmill. As their income increases from $60,000 to $100,000 to $200,000 a year, their expenses rise in perfect lockstep. The small apartment becomes a bigger house in the suburbs. The reliable Honda becomes a luxury BMW. The simple vacation becomes an expensive international trip. Their spending expands to meet, and often exceed, their income. They are earning more money than ever before, but they are still living paycheck to paycheck, trapped by their own success. There is no flywheel, because there is no surplus capital. Their powerful income engine is completely disconnected from their investment engine. They are running faster and faster just to stay in the same place. This is a quiet, comfortable path to financial mediocrity. It is the default setting for most people in our consumer-driven society, and it requires a conscious, deliberate system like the personal flywheel to break free from it. The direct financial connection of building this flywheel is the difference between linear and exponential growth. Let's create one final side-by-side projection. Person A is a disciplined saver. She invests a flat $1,000 per month for 40 years, earning 10% per year. A very respectable plan. Person B starts at the same level, investing $1,000 per month. However, she builds a personal flywheel. Through her commitment to upskilling, she manages to increase her income, and, as a result, her investment contributions by an average of just 5% per year. It's a small, incremental improvement. The results are anything but small. After 40 years, Person A, the flat investor, will have a portfolio worth about $5,300,000. A fantastic outcome. Person B, the flywheel investor, however, will have a portfolio worth over $12,700,000. The small, consistent act of increasing her investment rate, of ensuring her flywheel accelerated each year, resulted in more than double the final outcome. That extra $7 million is the financial manifestation of synergy. It is the tangible reward for building an integrated system where your career ambitions and your investment strategy are not two separate things, but two perfectly synchronized gears in a single, powerful machine designed for one purpose: to achieve financial independence. You have just absorbed a complete mental framework. This isn't just a set of tips. It is a cohesive system, a powerful blueprint for structuring your entire financial life. You now understand that the foundation is not the money you have, but the money you can earn, and that the single best investment is always in your own skills. You've learned that your greatest asset is time, and how to wield it by automating your decisions and ignoring the short-term noise that derails everyone else. You have the specific practical tool, the low-cost S&P 500 index fund, that serves as the simple, brutally effective engine for your wealth. You know that the greatest enemy is the speculative temptation that whispers from within, and you now have the defensive discipline of the circle of competence to protect your capital. And finally, you have the master plan, the personal flywheel, that integrates all of these concepts into a self-reinforcing system that can create exponential growth. You possess the operating system. But having the system and knowing how to execute it under extreme duress are two very different things. The blueprint you've just learned is designed to work flawlessly in a calm, rational world. But we do not live in a calm, rational world. We live in a world of market crashes, of pandemics, of geopolitical shocks, and of personal crises. The next level of mastery is not about strategy. It is about psychology. It's about forging the emotional fortitude to stick to the plan when every instinct in your body is screaming at you to abandon it. It's about understanding how to manage fear when your portfolio is down 40% and how to manage greed when it feels like you can't lose. The system is the ship, but your psychology is the captain that must navigate it through the storm. The video that is now appearing on your screen is the missing link. It is the bridge between knowing the path and being able to walk the path. It is the next piece of the map, the one that connects the cold, hard logic of the system you've just learned with the chaotic, emotional reality of executing it for decades. That content is designed to forge the psychological armor you will need to see this journey through to its conclusion. This isn't about simply watching another video. This is a conscious decision. It is a commitment to move beyond the level of the amateur who knows the rules and to ascend to the level of the professional who can execute under pressure. It is the choice to complete your mental arsenal. Continue your ascent. The next step is waiting for you.